Gold just shattered the 4,000 per ounce mark. And if you think this is just another precious metal rally, think again. I'm Iggy from The Investing Iguana, ranked 8th in Tiger Broker's 2024 Influential Tigers, with over 1 million reads, 58,000 likes, and more than 1,000 videos produced. My focus: US, regional, and global economic trends. This video is adapted from my latest in-depth Substack deep dive, and we're about to unpack the real forces behind gold's seismic surge and what it means for your portfolio. We'll cover the Fed pivot, central bank buying, ETF revival, dollar weakness, geopolitical tailwinds, and technical momentum, in that order. This is no panicked spike. Gold's 53.83% year-to-date rally comes from a perfect storm of monetary shifts, geopolitical tensions, and investors fearing they're missing the train. Imagine a ship, calmly but steadily steering into uncharted waters. That's gold today, moving beyond its old crisis-only narrative. Picture Jerome Powell standing at a crossroads. Inflation had cooled, but the labor market faltered. Now, the Fed's October meeting shows a 94.6% chance of another rate cut, targeting 3.75% to 4.0% by year end, with more cuts next year. Lower rates reduce gold's opportunity cost. Add a US government shutdown choking economic data and shaving GDP growth, and you've got a central bank almost compelled to be cautious. For gold, that's rocket fuel. Not all gold demand is flashy. In 2023, central banks bought over 1,000 tons, their second highest tally ever. By mid-2024, already 694 tons. Picture massive vault doors closing on bars of gold in Beijing, Istanbul, and New Delhi. Physical assets immune to sanctions. The freeze of Russian reserves in 2022 was the wake-up call. Goldman Sachs thinks the buying will keep pace into 2026. This is structural, not speculative. Western ETFs saw their biggest inflows in 3 years this September. My favorite chart here shows steady, broad-based buying. Retail participation up 213.5% year on year. It's not panic buying, it's careful repositioning. Imagine a suburban investor, not a Wall Street wolf, checking her portfolio and deciding gold belongs next to her tech stocks and municipal bonds. That's the new reality. With the US dollar index down 10.5% in the first half of the year, gold gets cheaper for foreign buyers. Historically, dollar down equals gold up, but now safe haven demand sometimes lifts both. The shutdown is a prime example where uncertainty trumps old correlations. You can't just watch the DXY anymore. You need to track macro risk signals. From Tokyo to Paris, political uncertainty fuels gold demand. Think of the debasement trade. Buying gold as insurance against fragile fiscal policies and ballooning government debt, now over $92 trillion globally. Tariff wars, Fed independence threats, each layer adds pressure to traditional assets. And gold? Neutral, stable, respected. Goldman Sachs revised forecasts sharply. Now $4,900 by December 2026. Charts show persistent uptrend resilience even after overbought signals. While some analysts expect pullbacks, the cocktail of central bank buying, ETF revival, and geopolitical unrest means dips likely stay shallow. Traders eyeing round numbers like 4,000 may take quick profits, but deeper holders see this as the beginning of the re-rating era. This isn't just gold breaking a record. This is gold being repriced for a new monetary and geopolitical reality. My lesson? In times where uncertainty is permanent, safe haven assets shift from insurance to core holdings. For US investors, think of gold as part of your macro hedge. For international investors, gold is now a universal language of protection. Gold's $4,000 milestone is more than a number. It's a signal. In this volatile, interconnected world, ignoring gold might mean ignoring one of the strongest macro trends of our time. For full charts and my written playbook, hit the Substack link in the description. And if you're serious about staying ahead of moves like this, consider joining the Investing Iguana membership. Weekly deep dives, timely alerts, and global macro context, with your portfolio in mind. Next, I'll cover how silver might ride gold's coattails into its own breakout, so don't miss that.